Now, from the previous sessions, we have been dealing with assets and liabilities. Now, today's session, friends, we want to deal with the presentation of financial statement. That's IS1. We want to talk about IS1, that is presentation of financial statements, for publication. Presentation of financial statement for publication. Now, according to IS1, friends, we are required to prepare financial statements for publication. One of the financial statements, let me say, according to IS1, the following financial statements should be prepared for publication or presentation. Let me say presentation as well. Presentation. Now, 1 or A, we have the statement of profit or loss. Statement of profit or loss account and other comprehensive income. B, statement of changes in equity. Statement of changes in equity. C, statement of financial position. D, we have a statement of cash flow. Presented in accordance to IS7. Then E, we have the notes to the financial statements. Those are the items that will be required to be presented for publication. Now, friends, remember, when we say IS1, we mean these 5 items. However, in the preparation of the statement of cash flow, we must have done it together with the presentation of financial statements for consolidation. Anyway, we are going to introduce and explain some of them here and then try to do a question. What is complicated or complex in this presentation of financial statement for publication is the adjustments. Sometimes our students are given a question with some additional information that will require you to make some necessary adjustment in respect to this. The format does not have a problem. The problem is those adjustments. But you should remember, not all items require adjustments. Some items don't have an adjustment. They will simply be recorded or recognized directly the way they appear in the trial balance. So you'll always be given a trial balance and additional information. You'll be required to use the information in the trial balance and the information, the notes to the additional information. Then you prepare the financial statements for publication. Fine. I may not want to talk about the cash flow at this point because we talked about it. But if there will be need, then definitely I'll come back to the statement of cash flow for an individual company. Fine. We want to proceed. Now, friends, we must have talked about statement of profit or loss account in statement of in our consolidation. Now, statement of profit or loss account and other comprehensive income is simply the statement of profit or loss, which was initially referred to as the income statement, and other comprehensive income. The other comprehensive income is simply the gain or loss on the valuation of assets. We have the actuarial gain or loss. We have the foreign exchange gain or loss. Those are the other comprehensive income. We are going to look at that. Then when you talk of the statement of changes in equity, is simply the statement showing the flow of equity. Equity is the ratio of assets after deducting all the liabilities and represented by ordinary share capital. We have the reserves, we have the preferential capital, and what have you. Then we also have the statement of financial position. That's what we used to refer to the balance sheet some time back. Then we have the notes of the financial statements, simply the explanation of what you have presented in your notes in your statement of financial in our financial statements. Fine, friends, we want to start off with the statement. With the statement of profit or loss account, and other comprehensive income, for the year ended. Let me say 31st, maybe 31st December, like that. That's just a format. We want to look at this. We want to look at the format. How do you prepare the statement of profit or loss? Friends, the statement of profit or loss will mainly be presented where expenses are classified by function. However, we also have a scenario where we can classify expenses by their nature. It's not the most preferred, but the most preferred method is where we classify expenses by function, meaning we identify the functional heads like the cost of sales, admin expenses, distribution costs, and all other expenses will be recognized under those functional heads. But where we are classifying expenses by nature, then we are just going to disclose the expenses as they appear or as they occur. We are not going to classify the expenses under functional heads. We'll talk about it again later. So our statement of profit or loss, you start with the revenue. Let me just have like the two columns here. We have the revenue. The revenue, or we used to call that sales. You recognize the sales there. Then we less our cost of sales. We less the cost of sales. Cost of sales here, friends. Remember, cost of sales in this case will include cost of sales. We have the opening stock plus the purchases minus the closing stock. But apart from those items, we may also include depreciation expense on productive assets. We may also include the gain or loss on sale of an asset as part of the cost of sales. Very important to remember that. So we come and say we have the gross profit. We have the gross profit here, friends. The gross profit. Then we may add other incomes. So the other incomes will be added. Then we less expenses. We less expenses here. One of the expenses here, friends, may be administration expenses or costs. Administration expenses or costs, we subtract it directly there. Then we also have distribution costs. Distribution costs or expenses, you subtract it directly here. You also have other expenses. Other expenses may be like impairment losses. Other expenses, you recognize it here and you subtract it. Then we have the profit from operations. Profit from operations. The profit from operations. Profit from operations, you have it here. Then you are going to less the finance costs. Remember the finance cost, friends, is the interest expenses. We have the bank charges. We have the bank maintenance fee. We also have dividend on redeemable preference shares. That is a finance cost. So you come and now adjust the finance cost here. Then we also add investment income. Remember, investment income can also be recognized. Immediately under other incomes. So you recognize this investment income. Then we have the profit. We have the profit before tax. We have the profit before taxation. Then we less the tax expenses. The tax expenses here. Our tax expenses, one of the tax expenses component is a corporation. The corporation tax expense for the year. So you recognize it here. Then you also have an under. You may have an under or over provision or over provision or over provision of tax in prior year. If there was under provision, then you increase your tax in this year. If there was an over provision, you reduce your tax expense for the year. Then you may have the deferred tax. You will have the deferred tax expense, or you may have a deferred tax income. So you come and now recognize it here. Then we recognize if there's a deferred tax income. Then the net tax expense will be put in the extreme corner so that we are able to get the profit for the year. Now, remember, friends, up to this point in time now, we have our statement of profit or loss. But we are going to add other comprehensive income. The other comprehensive income here, we may have gain or loss on revaluation of assets. If it's a gain, we are going to add. If it's a loss, we are going to subtract. Apart from the gain or loss, we may have the actuarial. Actuarial gain or loss from employment benefits. So you'll have this one here. We may have the tax on revaluation surplus. The tax on revaluation surplus, you're going to adjust the tax on revaluation surplus. Remember, this one is the non-current assets. You need to remember, these are the revaluation on non-current assets. If there is a revaluation surplus, then there is a tax on revaluation surplus. Then at that point, we'll get the total. We'll have to get the total there. The total comprehensive income. So that is our statement of profit or loss and other comprehensive income. Friends, remember, the cost of sales will be opening stock plus purchases minus closing stock, including depreciation on productive assets, and also gain or loss on productive assets, on sale of productive assets. Other incomes may be we have sold an asset at a gain. That's other incomes. We have admin expenses. Admin expenses, other than the normal administration expenses, for example, repair, we have painting, we have printing and stationery. Apart from the salaries and wages, apart from other staff costs, we will also have depreciation on building, depreciation on furniture and fittings. The same story with the distribution costs. Other than the selling and distribution expenses, we'll also have depreciation on motor vehicle, depreciation on delivery vans. That will be part of the distribution cost. Then we have the other expenses. Maybe we have sold an asset at a loss. We have also impairment losses. That will be other expenses. We have the finance costs, as we said. These are the interest expenses on borrowings. We have the bank charges. We have the bank maintenance fee, not forgetting the dividend on redeemable preference dividends. Then we have the investment income. These may be dividend we have received. We also have, an increase or decrease in fair value of financial assets through profit or loss. Then we have the tax expenses. We have talked about tax under IS 12. Remember, is one of the items that we must have discussed in our lessons under assets and liabilities. Friends, we then get the profit for the year. Then we add other comprehensive income accordingly, and then we get the total comprehensive income. Friends, we'll need to move on further and look at how we prepare a statement of changes in equity. In fact, before of equity, the statement of changes in equity. Now, before I go even to that point, for the year ended 31st December, like that. Now, before I go to that extent, remember, we have prepared our statement of profit or loss by classifying expenses by function. where expenses have been grouped in various functional heads. That's the cost of sales, other expenses, admin expenses, distribution costs, finance costs. In some cases, we may defy recognizing expenses under various functional heads. Instead, we recognize expenses as they arise. If, for example, instead of recognizing depreciation under cost of sales, we simply recognize depreciation as an expense directly. Instead of recognizing repair and maintenance under admin expenses, we simply say repair and maintenance. We disclose the word repair and maintenance. That's not the most preferred for presentation. The one preferred for presentation is where we are classifying expenses by function. That's important. Now, friends, you need to remember, this is not a very, very unique element that we are introducing today. This is something that we have also been doing under consolidation. This is something that we must have done because we were preparing financial statements for consolidation. We must have looked at this order. Only that one of the unique areas we are going to see is that for an individual company, you will be given some other adjustments, either to increase the cost of sales or to reduce the cost of sales, either to increase admin or distribution or other expenses or to reduce them, either to identify the finance cost, increase it or reduce it and recognize it there, either to identify the investment income by increasing or reducing and recognize it there. That's what we are going to do. And we are going to identify the tax expenses. We are going to identify the other comprehensive income. That's the only scenario that we are going to face under this area. Fine, we come to the statement of changes in equity. In the statement of changes in equity, as we must have said, remember, equity, statement of changes in equity is a statement that will show the flow or movement of equity during the year. And equity, as we must have said, is simply the ratio of assets after subtracting all the liabilities and represented by the capital and reserves. We have the ordinary share capital, we have the preference share capital, we have the share premium, we have the retained earnings, we have the general reserves. Those are the elements presenting equity, the owner's equity. Fine, this, and again I repeat on that, that is what would represent what the financiers or the owners of the company have financed in that particular company. So let me also have, I will not have all the items, but I'll have as a few just to represent the rest. We'll have the details, right? Then we have the ordinary share capital, We have the share premium. Let me just call this one share capital because we may also have not only preference, not only ordinary, but we also have preference, share capital. Then let me make it a little bit clearer. We make it a little bit clearer. Come and say, this is share capital. Then we have share premium. Remember, share premium is a reserve. Then we have retained earnings. Then we have other reserves. Then we have total. Friends, other reserves may be revaluation reserve, general reserve. We may have capital redemption reserve and other equity options. So we have many examples of reserves. So I've said other reserves. I may not exhaust all of them because of even space, and this is just a format. We start with the balances brought down. At the beginning of the period. And we give the total. We talk about the issue of shares, at a premium. If we have issued at a premium, then we are going to recognize here, and we recognize the premium. Then we get the total, we recognize it in the extreme corner. Now, friends, you need to remember that this one will be the par value. This one will be the par value. The par value, and this one will be the premium. Very important to know that. Then we also bring in the profit for the year. Profit for the year. Remember, the profit for the year, friends, is the one that we identified from our statement of profit or loss. Very importantly, so we bring it here, we add it here, then we take it to the total there. We may have dividend paid in the year. The dividend paid in the year will be subtracted here. The dividend paid for the year will be reducing our retained earnings. Then apart from that, we may have a revaluation surplus. We may have a revaluation surplus, or let me just say gain or loss, so that we have the two, gain or loss. We may have a revaluation gain or loss. Maybe it's a gain. We may have it as a gain, or it may be a loss. So you bring it here as well, then you subtract that accordingly. Then we also have a transfer. We may have transfer of reserves to retain earnings. Transfer of reserve to retain earnings. If we have transferred, we have reduced this, then that will be the order. But we may also have transfer. We may have transfer of retained earnings to reserves, to other reserves. If it's to other reserves, then we are going to reduce this and we increase our other reserves. Then apart from that, friends, we may also have other items. We may have other items like the tax on revaluation surplus. Tax on revaluation surplus. If there is a revaluation surplus, there is a tax on revaluation surplus. We are going to adjust that accordingly, and we put that here accordingly. That's the tax on revaluation surplus. We talked about that under IAS 12. Then apart from that, friends, we may also have a bonus issue. This bonus issue we increase our par value. The bonus issue may either be financed by the share premium. I'll put an asterisk there. Or it was financed by the retained earnings, or it was financed by the other reserves, So there is nothing here. So why I put an asterisk there is that these bonus shares can either be financed by the share premium, so we reduce the share premium, or it was financed from the retained earnings, so we reduce the retained earnings, or it was financed from other reserves, so we reduce the other reserves. Other reserves may be revaluation reserve, general reserve, capital redemption reserve, and what have you. So remember that this bonus issue are shares issued for free to the existing shareholders. And if that is the case, then we are going to increase the share capital. We will not receive any extra funds from the shareholders. We increase our share capital, but we reduce the source that financed, the internal reserve that financed the bonus. That's exactly what I've said. It can be financed by the share premium. It can be financed by the retained earnings. It can also be financed by other reserves. Apart from that, now we get the total. These are the totals, friends. These are the totals that will be reported. To the statement of financial position. These are the totals that will be reported in the statement of financial position. That will be the totals that will be reported in the statement of financial position at the reporting date. Now that's the statement of changes in equity, friends. We now want to look at how a statement of financial position will be like. A statement of financial position, that is item C. The statement of financial position. Statement of financial position normally as at as at 31st December. Remember now this one is as at. The other one was for the year ended and for the year ended. But this is as at 31st December, maybe 2017, 2018, 2019, and what have you. So we are going to have this. We are going to have this column. Now for presentation purposes, something I need to remind you, for the purpose of our practice, and these are some of the trainings I normally give to one of the firms that I'm a consultant. We normally give this kind of training that you'll always be required to give the notes. You'll always be required to give the relevant notes. Even in this, you may be required to give the relevant notes. You'll be having a column, maybe this can be note number maybe 4A, right? This can be 4B, right? This can be 4C, like that. This can be notes. The notes will be explaining. They will be explaining. Even this one can be 4D, like that. This one can be 4E, like that. This one can be 4F, like that. This one can be 4, right? There's something, so I'll leave out this one. 4F, like this one. This one can be 4G, 4FG, like that. And what have you. Even this one can be number maybe 4H, like that. So we have this 4H. So for practice purposes, it's important to always explain how we have arrived at this figure in our notes to the financial statements. The same thing for our statement of financial position. We may also have notes. We may have notes. We may have a column for notes. Now, we start with the assets. We start with the assets, and we have the non-current assets. We have the non-current assets. Non-current assets. Under non-current assets, we have property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment. We recognize the net book value. Maybe it can be a note number, let me give it arbitrarily, give it like note number 5A. We may have it as note number 5A, so you have this item there. Now this 5A will be talking about the movement schedule, the property, plant, and equipment movement schedule. How did we arrive at this figure? And it will be in the notes to the financial statements. But for exam purposes at this level, we may not be required to give the notes. You may not be required to have all these notes, and that's why I put in a different color. It may not be necessary at this level especially. But I'm just bringing this out for practice purposes out there when we'll be doing this for our own good as a profession. Then we come talk about the intangible assets. We talk about intangible assets. We talk about the intangible assets. These intangible assets may be explained in note number 5B, so you come and talk about it here. That is intangibles, right? We may have available for sale, available for sale, financial assets, financial assets, right? Then this one can maybe be explained in note number 5C. So you recognize this one. And any other assets, other long-term assets, I think that will be important, other long-term assets. So you have this one. Let me call this one item A. Let me call this one item A. Then you move on to current assets. You have the current assets. Current assets, you have the current assets. The current assets, we have inventory. We have inventory. We have inventory. Maybe inventory is a note number maybe 6A, something like that. So you have it here. You'll have it here. Then you have the trade receivables. You'll have the trade. In fact, before trade receivables, friends, you may have non-current assets. Non-current assets held for sale. Held for sale. In 6B, so you have it here, and you explain it in the notes of the financial statements. Non-current assets held for sale is in respect to IFRS number 5, where we have now a non-current asset that we have decided we are going to sell it. We are not going to use it anymore. So it will be reported as a current assets, and it will be reported as the lower of the carrying amount or the fair value less cost to sell. Then we also have another item, trade receivables, trade and other receivables. These are simply our debtors. These debtors can be explained maybe in note number 6C, somewhere there. So you'll have this item accordingly. Then we may have cash at bank, or at hand. Cash at bank or at hand, you recognize it here. Or sometimes you call it cash and cash equivalent, right? That is what we can do. Or we may have this item, financial assets at fair value, right? At fair value. Financial assets at fair value. This item can be explained in note number 6D, right? So you'll have this item in that order. Even this one can be, let me say, this one can be 6D and this one can be 6E, like that. We may have other cash and a cash equivalent. Other cash and cash equivalents. If there is any other cash and cash equivalent other than the two, these two can be cash and cash equivalent. So if there is any other which can be explained in this area, then it will be reported accordingly. Then we have this total. Let me call that one item B. So you'll have the total assets. Our total assets, friends, will be A plus B. That's the total assets will be A plus B, and that's the figure that we are going to recognize there. Then we have the shareholders' equity. We have equity and liabilities. We have the equity and liabilities. So equity, we start with the shareholders' equity. Shareholders equity and reserves. Shareholders equity and reserves. Shareholders equity and reserves. One of the items of the shareholders equity and reserves will be, ordinary share capital. Ordinary share capital, you recognize it here. We also have share premium. You recognize it here. We also have retained earnings, simply the items that we got from our statement of changes in equity. We have the retained earnings. We have other reserves. Remember, these items, we are getting them from the statement of changes in equity. So other reserves, e.g. revaluation reserves. So we have this item. Let me call this item C. Then we have non-current liabilities. Non-current liabilities. Non-current liabilities will be items like deferred tax, we'll also have items like the long-term debt, loan stock, loans, borrowings. We have redeemable preference shares. We also have finance lease obligations. Finance lease obligations or obligations under finance leases. So those are the main, and any other liability and any other amount that is due more than 12 in the next 12 months. So we have these are the total. Let me call that one D. We'll also have current liabilities. Current liability, your friends, will be, we have the trade and other payables. Now, some of these will also be having a note. Maybe we have a note of 6. Let me not call it 6. Let me call it 7 or 8. 8A, something like that. So you'll have a note for that. Because trade and other payables may include even other items like related parties. Then we also have current tax. The current tax will have to be explained together with the deferred tax. Maybe something like this one was either 7A. This numbering I'm putting are arbitrarily. They're not constant. They're arbitrarily. So this one will be 7A. We may also have finance lease obligations. Finance lease obligation can be an uncurrent and a current at the same time. The amount due within the next 12 months or the amount due within the 12 months or the next 12 months is a current liability. So any other amount that is due within the 12 months or within the next 12 months will be a current liability. That's very important to remember. So you have this, and this will be item E. Let me call that item E. So finally, you get the total. You'll have the total equity and liabilities. The total equity and liabilities, friends, will be item C plus item D plus item E. That's what you'll get here. And that's how a summary of the features that you should be able to see in your statement of financial position.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.